Welcome, curious minds, to the deep dive. You know how sometimes a topic just keeps popping up?
Yeah.
Like everywhere you look?
Oh, yeah. In articles, maybe you hear it mentioned on another show.
Exactly, until you finally think, okay, I need to actually figure this out. That was me with reverse mortgages. For, honestly, quite a while, I'd hear about them, see things, and mostly I'd just kind of dismiss them. I have my ideas, pretty fixed ideas.
We all do sometimes.
But then, a few months back, I decided, right, I'm diving in. Cleared the diary, sat through this really comprehensive presentation, something maybe like an expert, say, Emmett Clark over at loansbyemmett.com might give,
Right, getting the full picture.
Yeah, and I went in fully expecting to just confirm what I already thought I knew.
Ready to tick the boxes?
Totally. But what I actually heard, it just completely turned my understanding upside down.
Oh, how so?
Well, it sounded so much like the chats I have every day. About managing retirement income, tax strategies, that big one sequence of returns risk.
The danger of markets dropping right when you retire.
Precisely.
Yeah.
But this presented a totally different tool, something I hadn't really considered in that context.
A new angle.
Yeah, it honestly made me rethink a lot.
And that shift, that kind of aha moment, that's really what we're aiming for today. We want to cut through all the noise, the old myths around home equity.
Right.
And specifically look at how reverse mortgages might fit into a bigger retirement plan.
So not a sales pitch.
Definitely not. Our goal here is just to pull out the key facts, the data, the actual outcomes from the material we looked at. Give you the important stuff so you can understand this pretty complex area.
Exactly. Because when my own ideas about these things started to just, crumble, it made me realize that maybe the advice a lot of us give, maybe even me sometimes, didn't quite match up with what's actually possible now.
Interesting.
It felt like finding this hidden lever for retirement planning that nobody talks about.
Yeah.
Which led me straight to the big question.
Yeah.
Why? Why aren't we all talking about this more? It seems huge.
It's a great question.
So let's dig into that. Why is this massive asset? I mean, home equity is often the biggest asset someone has. Why is it so often left on the sidelines in financial planning? The source material we have points to, 4 really interesting reasons.
Okay, let's unpack them. The first one the source identifies is what it calls common oversight.
Common oversight.
Yeah, and it's basically a structural issue in how financial advice often works. A lot of advisors, really good ones, masters of investments,
Right.
they just aren't really trained or maybe incentivized to weave home equity into the core financial plan.
So it's like a blind spot.
Kind of. Their focus, maybe their pay structure, it's often tied to managing liquid assets, stocks, bonds, that kind of thing.
And the house just sits there.
Exactly. It's this huge potential resource just sitting there on the balance sheet, not really part of the active strategy, a big piece of the puzzle left out.
Okay, that makes sense. And the second reason, this one feels familiar. Bad PR.
Oh, yeah. That one looms large.
We've all heard the horror stories, right? The really scary ones about especially widows getting kicked out of their homes.
Those narratives are incredibly sticky. Chilling anecdotes, really. And whether they were fully accurate back then or a bit sensationalized,
They stick.
they absolutely stick. And they create this, emotional wall, not just for homeowners thinking about it, but for advisors, too. Makes everyone hesitant.
Understandably hesitant.
Right. But this is where digging into the actual history, the facts, becomes so important if we want to get past those old fears.
Okay.
What's really fascinating and kind of frustrating is how old info can just keep shaping how we see things today, even when things have changed. A lot.
So what's the reality now?
Well, the source is super clear on this. That specific awful issue, the non-borrowing spouse potentially losing the home after the borrower died.
Yeah.
That came from an older policy where federal protections just didn't cover them. Plain and simple. But, and this is the absolute key takeaway, the policy was corrected years ago.
Erected. How?
There are federal rules now. They ensure that a non-borrowing spouse, under specific conditions, they can stay in the home after the borrower passes. They have to meet certain criteria, of course, like keeping up with taxes, insurance, the basics.
But they can stay. The eviction nightmare isn't automatic.
Exactly. Understanding that change is vital. It lets us move the conversation from those old fears to what these look like today.
Okay, that clarification about spouses is huge.
Right.
It really does clear the air on a major fear. So if we can kind of set aside that outdated fear, what's the third reason home equity gets ignored? This is where you said it gets really interesting, right?
Yeah, this is the unknown benefits part. And it's where the source really highlights things that, honestly, most people just don't know about, almost like hidden advantages for retirement.
Hidden advantages. I like the sound of that. What's the first one?
The first big one, it eliminates the monthly mortgage payment.
Whoa. Okay, just eliminates it.
The principal and interest payment, gone. Think about that. The source mentions nearly half of Americans are still paying a mortgage when they hit retirement age.
That's a huge chunk of change every month.
Exactly. Imagine the stress relief, the sheer financial breathing room that gives you. No more of that single biggest bill each month.
You could use that cash for, well, anything.
Yeah.
Travel, healthcare, just padding the emergency fund.
It fundamentally changes the cash flow equation in retirement. Takes off a massive constant pressure.
Okay, but there has to be a catch, right? You don't just get a free house.
No, definitely not. And the source is very clear here. This is a crucial caveat. While that mortgage payment goes away, the homeowner is still completely on the hook for all the property-related costs.
Like property taxes.
Yep, property taxes, homeowners insurance, any HOA fees if you have them.
Uh-huh.
Plus, you have to maintain the home, keep it in decent shape, and critically, you have to live in it as your main home, your primary residence.
Got it. So, not a free ride, but getting rid of that core mortgage payment is still a massive deal.
It's a game changer for cash flow.
And that leads right into the next point, doesn't it? That it can serve as an additional retirement resource.
Precisely. It ties into that bigger idea. Why wouldn't you use all the tools in your toolbox for retirement?
Right.
If you've got potentially hundreds of thousands of dollars locked up in your house, just sitting there illiquid,
Yeah.
doesn't it make sense to at least explore ways to access some of that wealth strategically without having to sell the place you love?
It seems logical when you put it like that. Use what you have.
Use what you have. And then there's another huge point, one that tackles a really deep fear many people have: non-recourse legal protection.
Non-recourse. What does that mean exactly?
It's like a built-in safety net. It means that you, or crucially, your kids, your heirs, your estate, they can never owe more than the home is eventually worth when the loan is due.
Never. Even if the loan balance grows higher than the home's value. Maybe interest adds up or the market crashes.
Never. That's the non-recourse part. The debt is secured only by the property itself. It's backed by federal insurance, typically through the FHA's HECM program, that's Home Equity Conversion Mortgage.
So it's insured.
Yes. And the source puts it bluntly: the homeowner literally signs a liability release document when taking a reverse mortgage.
Wow. So that whole fear of leaving your kids with a massive bill.
It's specifically protected against. If the home's value is less than the loan balance when it's sold, the lender can't come after your other assets or your heirs' assets. The insurance covers the difference. The property satisfies the debt.
Okay, that's incredibly reassuring. That's a biggie.
It is. And tied into that is something the source calls underwater insurance.
Underwater insurance, like if the housing market sinks.
Essentially, yeah. It reinforces that same protection. You never owe more than the home is worth. It's another layer ensuring the loan doesn't become this albatross if property values fall. Takes that market risk off your shoulders.
So multiple layers of protection there. Non-recourse and this underwater insurance.
Exactly. But maybe the most compelling benefit, especially when you think about unexpected life events, it's the disaster-resistant line of credit.
Disaster-resistant. How does that work?
Okay, think about regular home equity lines of credit, GLOCs.
Yeah, lots of people have those.
Right. But the source points out something crucial. Remember 2008, the financial crisis?
Oh, yeah. Vivid.
A lot of those ELOCs got frozen. Banks just shut them down, cut off access to the money.
Right when people needed it most.
Precisely. Plummeting home values, banks in crisis, they pulled the plug. But federally insured reverse mortgage lines of credit, the source says they remain accessible even when property values drop or the home is damaged.
Even if the house is damaged.
Yeah.
Like by a fire or flood.
Yes. The source says no contractual provision to freeze it. It gives these really powerful examples. If a borrower's home is destroyed by fire in California, flood in western North Carolina, or hurricane in Florida, the line of credit still remains available.
That is genuinely incredible. I hadn't heard that before.
It's a huge difference. Think about those awful situations. People had maybe most of their wealth tied up in their home. Maybe they were underinsured.
Right.
Disaster hits. Their equity is wiped out, but their regular mortgage payments are still due. And they can't tap the equity anymore.
Impossible situation.
Truly. But with this reverse mortgage line of credit, that access to funds remains, providing a critical financial lifeline during recovery.
Yeah.
It really makes you ask, as the source does.
Hmm.
Isn't a key job of financial planning helping clients reduce risk in retirement, especially catastrophic risk?
Yeah.
This feature seems to do exactly that.
That disaster protection angle is definitely food for thought.
Wow. Okay, so that covers the surprising benefits. What's the fourth reason for the oversight?
The fourth reason ties back to the planning process itself.
Uh.
Lack of integration in planning software.
Ah, the software tools advisors use.
Exactly. As you mentioned earlier, the home equity value is usually in the software. It shows up as an asset.
Yeah, you see it there. A big number, usually. But that's often all it does. It just sits there. A static number, it's illiquid, and it's not really used dynamically in the planning scenarios and the what-ifs.
It's like having a savings account listed, but never considering drawing from it.
Sort of, yeah. It's hard to think of any other asset of that size being treated that way today.
We model everything else, investments, income, pensions, you name it. But the house equity just exists.
It's a strange disconnect, isn't it, when you think about it?
It really is. Almost comical, like you said, if it wasn't so potentially significant.
And if you connect that to the bigger picture, well, actually integrating that equity, making it an active part of the plan, it could make a huge difference to someone's overall financial health in retirement. More resilience, more flexibility.
Right.
And isn't that what we're all aiming for? Using everything you have available to build the strongest possible retirement.
It should be. Not leaving major assets just dormant.
Leverage every tool, not just the easy ones in the investment portfolio.
The source also mentions something else here, kind of an added benefit. Maybe more for the advisor's perspective, but it impacts the client.
Oh, yeah. What's that?
He talks about using home equity as a third bucket, alongside income and investments.
Okay, a third source of funds.
Right. And the idea is, by strategically drawing from the home equity bucket, sometimes maybe during market downturns, you can let the other two buckets, especially investments, recover or last longer.
Ah, so it helps preserve the investment portfolio, lessens the sequence of returns risk we talked about earlier.
Exactly. So for you, the listener, it means your nest egg might last longer. You're less likely to be forced to sell investments at the wrong time. It protects your long-term plan.
That makes a lot of sense. It's about coordinating all the resources.
Yeah. So really, the core argument we're getting from the source material is pretty stark. It's saying that advisors who aren't having these conversations about home equity, they're often operating based on, well, outdated ideas, or maybe just haven't had the specific training on these newer tools. Right. The landscape has changed, but the conversation hasn't always caught up.
But the potential impact, the source argues, is just too important to ignore. Millions of retirees' financial security could be affected. We can't just leave this stone unturned.
And the sheer size of it. You can't argue with the numbers. Home equity isn't just some niche asset.
Not at all.
It's major. Especially here, where retirement savings, let's be honest, are often a bit shaky for many people. The source quotes is mind-blowing. Housing wealth for people 62 and older totals $14 trillion.
Trillion. With a T.
It's staggering. It's not just the house. It's a foundational financial asset for millions.
Yeah, absolutely.
Which makes the source's call to action feel really urgent. It's time to bring this conversation to the forefront, make it a standard part of retirement planning.
Couldn't agree more.
So wrapping this deep dive up, I think the big takeaway for me, and hopefully for you listening, is it's really time to challenge those old ideas about reverse mortgages.
Yeah, look past the scary headlines from decades ago.
And see your home equity not just as the static thing you only touch when you sell, but as a dynamic resource, protected, flexible, and potentially really valuable for your retirement strategy.
A strategic lever, as you put it earlier.
Yeah, exactly. A lever for your future.
And maybe this whole discussion sparks a wider question for you, the listener.
Yeah.
In a world where financial advice often gets really focused on investments, on income, what other assets, what other strategies might be sitting there kind of unused or misunderstood?
Interesting question.
Yeah, what else might be right under our noses that could be woven in to create a stronger, more secure financial life? It's definitely worth pondering.
That is a great thought to leave everyone with, thinking beyond the usual suspects. Well, thank you for joining us on the deep dive today. We really hope this conversation helps you look at your whole financial picture, and especially your home, with fresh eyes.
Hope so too.
Keep asking questions, keep exploring these crucial topics, and we will catch you on the next deep dive.